$400 billion froze overnight. Most people slept through it. The repo market, the heartbeat of the global financial system, stopped pumping. Not a glitch, not a technical error, a systemic rejection. Banks walked into the pawn shop with pristine collateral, U.S. Treasuries, the safest asset on earth, and got turned away. The plumbing seized, and when the plumbing seizes, payments freeze, liquidity vanishes, and the system enters cardiac arrest. By the end of this briefing, you'll see why the Fed's next move isn't strategy, it's forced surrender. The evidence is in the spreads, the flows, and the silence from the institutions that know exactly what's breaking. The overnight repurchase agreement market is the plumbing nobody sees until it breaks. Every night, banks need cash to meet regulatory requirements, clear payments, and fund operations. They can't just sit on their balance sheets and hope. They need liquidity. So they walk into the repo market with collateral, post U.S. Treasuries, borrow cash overnight, and return it the next day with interest. It's a pawn shop for institutions. Bring your best asset, get cash, redeem it tomorrow. The collateral is supposed to be pristine. U.S. Treasuries are the global standard for safety and liquidity. They're the asset that every central bank, every pension fund, every insurance company treats as risk-free. When you post Treasuries in the repo market, you're supposed to get cash at the lowest possible rate because the collateral is unquestionable. That's the theory. But theory and reality diverge when trust breaks. The repo market is where banks reveal what they actually think about the system. If they trust the collateral, they lend freely at low rates. If they don't, they hoard cash and demand higher rates, or refuse the trade entirely. That's what just happened. The spread between the repo rate and the Fed funds rate exploded. That spread is the only signal that matters. It tells you banks don't trust the collateral anymore. Let me explain why this matters. Without the repo market, banks can't meet daily cash needs. Payments freeze. Interbank lending stops. The system seizes. It's not dramatic, it's mechanical. If you can't borrow overnight, you can't function. The repo market is the circulatory system. When it clots, the body shuts down. Now, here's the setup everyone misses. The repo market isn't just about overnight liquidity. It's about confidence in the underlying asset. When banks refuse treasuries, they're saying something has changed. Either they fear the value of treasuries is falling, or they fear they won't be able to sell them later, or they fear holding them creates risk they can't afford. All three scenarios point to the same conclusion. The safe asset isn't safe anymore. The $400 billion freeze wasn't a one-day anomaly. It was a stress signal. Banks hoarded cash because they didn't want the collateral. And when pristine collateral gets rejected, you're watching the foundation crack. The question isn't whether the system is stressed. The question is how long the Fed can keep pretending it's not. The smoking gun is the spread. When the repo rate spikes above the Fed funds rate, it's not a technical adjustment. It's a market-wide vote of no confidence. Banks are saying they'd rather hold cash than lend it against treasuries. That's the signal. And when you dig into why, the evidence points to one conclusion. The biggest buyer of U.S. debt just became the biggest seller. China dumped $688 billion of U.S. treasuries. Not over a decade. Over the last few years. They liquidated nearly half their position from the peak. And they did it during a period when treasury prices were falling. They sold at a loss. That's not portfolio rebalancing. That's an exit. When the second largest economy in the world dumps treasuries at a realized loss, the market notices. But the market can't absorb that supply without consequences. Someone has to buy those bonds. And when China stops buying and starts selling, the entire supply-demand equation shifts. The UK and Belgium stepped in. Their holdings spiked to record levels. But here's the problem. They're not buying with trade surpluses. They're buying with borrowed money. The UK holds over $750 billion of U.S. debt now. Belgium, a country with a tiny economy, holds over $300 billion. These aren't organic buyers. These are political buyers. They're absorbing the supply because the alternative is a treasury market collapse. But political buyers are fragile. They buy until their own economies crack. And when they crack, the bid disappears. This creates a liquidity sinkhole. Banks see the supply hitting the market. They see the forced buying from the allies, and they start to question the value of the collateral. If China is dumping and the UK is straining, who's left to bid? The answer is nobody except the Fed. and the Fed can't admit they're the only buyer without admitting the system is broken. So banks hoard cash. They refuse to lend against treasuries because they fear those treasuries are about to lose value, or they fear they'll need that cash for their own survival when the next wave of selling hits. Either way, the repo market freezes, $400 billion of collateral gets rejected, and the system enters a liquidity trap. Here's the cascading effect. Treasury prices fall, collateral value drops. Banks demand more collateral for the same loan. Liquidity dries up, the spread widens, and the cycle feeds on itself. This isn't a temporary squeeze. It's a structural breakdown. The safe asset that underpins the entire financial system is being questioned by the institutions that used to trust it most. The contradiction is brutal. Treasuries are supposed to be risk-free. They're supposed to be the asset you run to during a crisis. But when the crisis is a crisis of confidence in the Treasury itself, there's nowhere to run. Banks are stuck holding an asset they can't sell without taking a loss and can't use as collateral without posting more cash. That's the sinkhole. And it's swallowing liquidity faster than anyone wants to admit. The Fed stepped in. They had no choice. When the repo market freezes, the Fed becomes the pawnshop of last resort. They inject billions through the standing repo facility. They flood the system with overnight reverse repo operations. They buy the collateral that banks won't accept from each other. And they call it routine liquidity management. But the scale tells a different story. This isn't routine. This is life support. The Fed is absorbing the supply that China dumped and the allies can't handle. They're monetizing the debt. They're printing dollars to buy treasuries that nobody else wants. And every dollar they print devalues the currency. The pattern repeats. September 2019, the repo market spiked to 10% overnight. The Fed intervened. March 2020, COVID crisis. The Fed flooded the system with trillions. Now, 2025 into 2026, the same playbook. The only difference is the cause. This time, it's not a pandemic. It's a structural rejection of U.S. debt by the world's second-largest economy. The Fed frames it as temporary. They say it's just smoothing out volatility. But temporary interventions that become permanent are the definition of systemic failure. The Fed is now the marginal buyer. They're the entity that steps in when everyone else steps out. And when the central bank becomes the only buyer, they're not managing liquidity. They're monetizing insolvency. Here's what that means for you. When the Fed prints to buy treasuries, they expand the money supply, more dollars chasing the same goods. That's inflation, not the inflation they measure with consumer price indices, the inflation that shows up in asset prices, in commodities, in the things you need to survive. The system didn't break because of a lack of money. It broke because of a lack of trust. And trust is the one thing the Fed can't print. The repo freeze is a rejection of the system's most basic promise, that treasuries are pristine collateral. When the plumbing breaks, cash in the wrong place becomes inaccessible. Subscribe to follow the plumbing, not the headlines. Join the WhatsApp channel for daily liquidity signals and Fed intervention updates. Don't let the complexity bully you. Stay liquid, stay disciplined, and I'll see you in the next briefing.